I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's Video Insight. The quality of a business is paramount in identifying investment opportunities, and this week I want to identify the impact pricing power has in delivering earnings growth. Pricing power will invariably allow a company to generate a return above its cost of capital, but it also yields another major benefit. One of the main mistakes I've seen in investors is basing an investment case on overly optimistic earnings growth assumptions. This will often stem from an extrapolation of past results using assumed market growth rate, then adding in a management estimate of benefits from cost reductions or efficiency strategies. Expectations of management are usually based on what they can see in a given point of time. Management usually seeks a strategy to optimise the performance of the business for foreseen circumstances. However, the real-world outcome is driven by a mix of foreseeable and unforeseeable influences. External factors impact companies all the time. Sometimes these factors will be positive for a company, but more often than not, they'll create challenges. Pricing power allows a company to offset negative external impacts, protecting investor returns and cash flow. Pricing power gives a company the ability to remain in control of its own destiny, rather than merely riding the waves of external factors. The ability of a company to mitigate the impact of negative external factors is the best test of its pricing power. Commodity companies are clear examples of businesses without pricing power. Their earnings and share price performance follow the fortunes of demand from China and global economic growth more broadly, combined with supply constraints and disruptions in their operations and among their peers. This demonstrates their limited ability to control their own destiny. This means as an investor, your ability to generate superior returns from resources stocks is largely dependent on your ability to forecast these external factors better than the broader market. As Warren Buffett once said, the single most important decision in evaluating a business is pricing power. If you've got the power to raise prices without losing business to a competitor, you've got a very good business. And if you have to have a prayer session before raising the price by 10%, then you've got a terrible business. That's it for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.